Hey traders, Jim here. In today's video, we're going to go over covered calls. We've already went over cash secured puts in a previous video. So I want to go through the covered calls. This is the next step in the wheel cycle. This is going to be your complete guide to generating consistent income from stocks you already own without taking significant additional risk because you already own the stock. Before we get started, we need to run through this disclaimer real quick. And this presentation is for educational and informational purposes only. It does not constitute financial, investment, or legal advice. Options trading involves significant risk. It is not suitable for all investors. You may lose some or all of your money you invest. Past performance is not indicative of future results. Always do your own research and consult a licensed financial advisor before making any investment decisions. OptiTrades is an educational resource and does not manage client funds or provide personalized advice. Let's get started. So what is a covered call? A covered call turns idle shares that you either already own or you were put from a cash secured put that you had in play and the stock went in the money. Now you own 100 shares of the stock. You want to sell a call on that stock. You sell a call option against those shares to collect an immediate cash premium. You collect that money right now as soon as you sell that covered call. That's yours. It goes into your account. Stay covered. Your shares back the contract. You're never exposed to a naked covered call or a naked call risk. Ideal outlook, this is best suited for neutral to slightly bullish view on your holdings. So what are the core mechanics? There's three concepts to the foundation of every covered call. First is the call option. It gives the buyer the right, not the obligation, to purchase your shares at the agreed upon price before expiration. The premium, the cash you receive up front for selling the call. This is your immediate, keep it no matter what income. Covered, you own the 100 underlying shares that fulfill your obligation if the buyer exercises the option. Step by step, how to sell a covered call. First, you own the stock. Second, you choose a contract that you want to sell at. Third, you sell a call at that contract price. Fourth, you monitor and manage. And fifth, you handle it at expiration. Choose what you're going to do depending on the scenario at the end of that expiration. Most brokers require a basic options approval level to sell covered calls, a straightforward process for most investors. And we went through this in the cash secured puts as well. So key decisions: do you want to sell in the money, shares called away? Do you want to sell at the money? It's balanced risk and reward. Do you want to sell out of the money? More upside. So what this really means is that if you're in the money, you're selling below what you own the shares at. Okay, you're probably going to get called away when it comes around. So you better make sure you're getting a good enough premium and you know you want to be called away. At the money, shares go down, you're probably not going to get called away, but probably a higher likelihood they're going to go up. Stocks usually go up more than they go down over time anyway, right? And then out of the money, that's where I like to be. I like to write my covered calls a little bit out of the money to capture the premium, but also get some of the share appreciation. Expiration date, that's days to expiration. Just as we do cash secured puts, I like to sell mine 30 to 45 days out. Now with covered calls, I'll go further out sometimes because I get a better return on my premium, especially if there's a lot of volatility in that stock. Longer DTEs, higher premiums collected, but your shares are committed for an extended period. The payoff, what can you earn? Here's an example premium. Let's say that we just collected $350 for selling one contract of Apple at the 185 price. And we collected $3.50 per share to 100 shares. Monthly return, we like to collect 1 to 3%, typical monthly yield. And annualized, anywhere from 25, 35, 36%, and on occasion, maybe a little bit less. But we usually get pretty good returns depending where you're going to sell that call at. Now, again, if you're selling at the money, that's your sweet spot for getting the highest max annualized return. All right. So if you're a little bit of out of the money where I like to be, this is probably going to be more like 25%, but you allow for some appreciation in the stock as well. Best case scenario is that Apple stays below the 185. You keep the full premium of $350 and your 100 shares. If it rises above the 185, you sell it at 185, you're going to be called out of it, and the individual that gave you the $350 will then assume those shares. Risks to consider. Covered calls are conservative, but not risk-free. You need to understand these trade-offs before you sell. The biggest one is the capped upside. Now, this is one that a lot of people talk about, and I'm going to tell you my feelings is that if I'm selling a covered call, I'm not worried about the stock going up, okay? I'm doing it to make the income. So if the stock doubles in price, I don't look back. I had that happen with Intel. All right. And I made great money on Intel. I would have made more by holding it, but that's hindsight, and you don't know that. But I know what I got paid when I sold that covered call. That was immediate in my account. I'm very happy with that trade. So if the stock surges well above the strike price, your gains are locked. You sell at the strike no matter how high it climbs. All right. Limited downside protection. This is another risk. News comes out, something happens, your stock gets hammered. Well, I'm still better off than the one that bought and held in this case because I got money for the covered call as well. So I have that stock at a premium from that cash secured put and then got a bigger premium and discount when I sold that covered call. So the premium cushions losses slightly, but if the stock drops sharply, you still absorb most of that decline. And that is true. And you're obligated to sell. If it exercised, you must sell your shares at the strike price, even if you'd rather hold them. When to use covered calls. This strategy shines brightest in 4 specific situations. Neutral to slightly bullish. Stock expected to trade sideways or rise modestly, not skyrocket. When you want to generate income, earn extra cash from shares you plan to hold long-term regardless. Lowering cost basis. Each premium collected effectively reduces what you originally paid per share. And you'd like to have higher implied volatility. Elevated IV inflates premiums, more income for the same trade. When to avoid covered calls. Strong bullish conviction. If you believe the stock will surge dramatically, selling a call caps the very gains you're expecting. Instead, let it run. Shares you won't sell. If you're emotionally or strategically unwilling to part with your shares at the strike price, don't take on that obligation. Low implied volatility. When IV is depressed, premiums are thin, the income generated may not justify tying up your shares. Covered calls, a powerful income tool. They generate income, turn a passive holding into a consistent monthly cash flow without selling your position, with the exception, of course, when you get called away. Manage risk, understand the cap on upside and the limited downside buffer before every trade. Stay strategic. Use the strategy selectively when outlook, volatility, and willingness to sell align perfectly. Covered calls are one of the most beginner-friendly option strategies. They're ideal for long-term investors looking to enhance returns on existing holdings. So come on over to www.optitrades.com, sign up for a free trial. We've added something new to this as well. It's called the community. So in the community, if you go to community tab, when you've joined up, you can come in and we can all discuss our trades. We can talk about general items here. We can talk about the wheel and we can talk about pure investing if you want to buy stocks and hold stocks. Okay. So come on in, meet me in the room. Let's take a look at your trades. Let's see how you're doing. We'll talk accounts and we'll have a lot of fun. Don't forget to subscribe and like this video. It helps us in our channel. It also helps us to grow the channel. We're still new on YouTube, so we're trying to get that really moving forward and bringing this product out. One other feature that I did add, if you don't like the light theme here on OptiTrades, you guys can click this little light button and take it to the darker theme, which is also kind of cool. And it just depends on how your eyes are and so on and so forth. All right, have a great day. We'll see you in the trade room.